The Taxpert Incorporation App 2223 shows you quickly and easily what the effect would be of a sole trader incorporating and trading through a limited company. And we start by inputting the level of trading profits. I've already input 200,000 here. And straight away, the calculator for the current tax year, 22-3, will work out the Class 4, the Class 2 national insurance, and the income tax liability from the sole trade. You can also input any other earnings. So let's suppose that this taxpayer has, let's say, rental income of 12,000 a year, 12,000 of property business profits, and maybe interest of £250 a year and dividends of 3,000 a year. And you can see as I put in those figures that at the moment it's showing savings from incorporation, but we haven't yet put in the relevant figures for the limited company. But if I just scroll down, you can see that the net income from the sole trade plus the other income for this taxpayer would be 125,000, and you'll see in the workings how we get to that figure. But if over here I then look at the limited company side, it automatically picks up the same profit figure of 200,000, but we haven't yet entered any salary or any other income. And what I'm going to do is use the optimize function. If up here I click on that optimize button, that will then work out what the optimal combination of salary and dividend is, assuming that we're going to extract all of the profits of 200,000 post-tax by way of salary and or dividend. Oh, just before I do that, let me just show you what I put in this year for the first time. Although this is for 22-23, I've put in a function whereby you can toggle between FY22 and FY23 to see the effect of the increase in corporation tax rates next year. So this time next year, we'll have a 25% rate on profits in excess of 250,000, a marginal rate on profits between 50 and 250,000, and the 19% rate only up to 50,000. And in fact, if I do that toggle now, then switch to FY23, are you sure? You can see that the corporation tax liability, if I don't have any salary, etc., is 49,250, whereas if it was FY22, it would only be 38,000. Because, fortuitously, and as far as we know at the moment, the income tax rates and national insurance contributions will not change next year. This does mean that this tool can actually be used to plan for incorporations, not just for the current tax year, but also for 23-24. Now, let's go back to this optimize function, and this will take a little while because in the background it's running through quite a complicated program. Oh, it's quicker than it was on my tax calculator, but never mind. What that's now doing is going to show me the optimal salary, 9,100, a figure that should be familiar, and then the dividends post-tax of 154,629, assuming that we are going to extract the entire net profit by way of dividend. And in fact, for this taxpayer, we're going to be worse off from the incorporation by 1,286, which is quite interesting. The reasons for that will be to do with the changes in national insurance. I'm not sure, I don't think it makes any difference. In fact, I'm sure it doesn't make any difference if I remove the other income from the sole trader, because that's already factored in and taken into account in bringing in the calculation. You can see here the total personal net income from the company plus other. Again, we've got that different figure. So for that person, I don't think we are going to incorporate. I wonder what it would be if they were Scottish. And as with our main calculator, we can switch between pension age. In fact, let's just do that first. So yes, very much not worth incorporating. Why is that? Well, it'll be to do with the national insurance contributions and the fact that of pension age, you're not liable. But the Scottish taxpayer has different tax rates to contend with, and actually, the Scottish taxpayer would be better off by incorporating, which is quite interesting. But let's just go back to this original example. And what I would suggest is that we consider the possibility of taking, let's say, £6,000 of interest. Suppose that the sole trader here finances the company with a loan to the company of, let's say, £100,000, and they take 6% interest. So they take out 6,000 of interest on that. Well, when I re-optimize, what I will find out is that all of that interest is tax-free, and that'll be actually not all of it because of the 250 on the other side, but we'll be able to use the rest of the 5,000 savings rate band and the personal savings allowance, maybe not any personal savings allowance because I think they've got too much income, but let's see what the end result is there. And yes, I can see, can I see? Yes, it's not so good. The incorporation is still worse by 1,269, a different figure. I'm going to reset it to 0 because it is quite a useful planning point. If we were looking at, let's say, a higher rate taxpayer, so a sole trader of 75,000, and we then optimize that. So what's the salary and dividend coming out of the company for that sole trader? And we then get the answer that the salary should be, again, I would imagine, oh, it's 11,908 there. That's quite interesting. There'll be a good reason for it, though. But there, you're better off by nearly 2,700. Oh, by the way, there's a workings schedule. If I click onto workings, it takes me to the calculation for the company, and that you can drill down and see all the different workings from that. If I go back to the main calculator, then, oh, and actually, because I like showing you these things, toggle that to FY 2023, it's only 1743 in that situation. But what I'm going to do now is put in that interest again of 6,000. And here I think it could make, I'm going to re-optimize to make sure that all the dividends come out. Maybe that's what I didn't do first time around. But if you re-optimize that, then instead of 2,289, we're going to be better off by 3,930. So that is quite a significant benefit if you factor in that interest. And again, if I toggle to FY23, you'll be saving nearly 4,000 this year, a bit less, but not far off 3,500 the following year on the different corporation tax rates. So there it is, a very powerful tool, simple, I hope, in its application, but behind it, a huge number of calculations because we're having to work out how best to allocate allowances and so on and build in all the different rules. But that will certainly help you advise your clients on whether their sole traders should think about turning themselves into limited companies.